Revenue barely moved. Operating profit fell by a fifth. Operating cash flow fell by more than a quarter. That is General Motors' first half of fiscal 2026. In the 6 months ended June 30th, GM reported $83.1 billion of revenue, up 0.5%, while operating expenses climbed by over $1.6 billion. Not a collapse in demand, a collapse in operating leverage. Costs rose, sales did not. Let's walk through what the filing shows. First, the ground rules. General Motors is a global automaker that also runs a large captive finance operation, and it reports two revenue segments, GM North America and GM International. The source is the quarterly report filed on July 21st, covering the first 6 months of fiscal 2026. Every income statement and cash flow figure here is cumulative for the half year, not a single quarter, and compared against the same 6 months of the prior year. The balance sheet is different. Those items are compared to the fiscal year end of December 31st, 2025. So when a balance sheet number moves, it moved since the start of the fiscal year. Headline numbers. Revenue of $83.11 billion against $82.73 billion a year earlier, an increase of just $381 million or 0.5%. Operating income of $4.39 billion, down from $5.48 billion, a fall of 20%. Net income of $3.93 billion, down 16% from $4.68 billion. And diluted earnings per share of $4.25 against $5.28, down 19.5%. Notice the pattern. The decline shrinks down the income statement, then widens at the per-share line. Both distortions have causes. This slide explains the half. Operating expenses rose to $87.27 billion from $85.66 billion, up $1.6 billion. Revenue rose by $381 million. For every extra dollar of sales, GM absorbed roughly $4 of extra cost. When a business with a largely fixed cost base grows revenue 0.5% and costs nearly 2%, the difference lands on the operating line with nothing to cushion it. That is why operating income fell 20% on a flat top line. The problem is cost and mix, not demand. And cost problems resolve on a different timetable than volume problems. Now the part that matters most. Pre-tax income of $4.92 billion came in above operating income of $4.39 billion, a positive $530 million from below the operating line. The tax charge also fell to $856 million from $1.2 billion, an effective burden of roughly 17%. That is why net income fell 16% when the operating line fell 20%. Reported profit is flattering the business. The operating line is the cleaner read on recurring earnings power. The diluted share count also dropped to 918 million from 989 million. A 7% reduction. That did not cause the earnings per share decline, it cushioned it. Earnings quality reads as medium, real and cash-backed but presented at its best angle. The segment split shows where the pressure sits. GM North America generated $76.31 billion, 91.8% of the total, and declined 0.7% year over year, roughly $560 million of lost revenue. GM International generated $6.55 billion, just under 8% of the total, and grew 13.9%, adding about $797 million. International is the only grower, and the reason group revenue was positive at all. But look at the arithmetic. A segment carrying 8% of revenue had to grow nearly 14% to offset a fractional decline in the 92% segment. A very thin lever. Group performance will keep tracking North America almost 1-for-1. Now the margin bridge. Gross profit is not broken out here, so the bridge runs from revenue to operating profit to net profit. Operating margin came in at 5.3%, down from 6.6%, a fall of 1.3 percentage points. Net margin was 4.7%, down from 5.7%, a fall of 1.0 points. The net line lost 0.3 of a point less than the operating line, and that difference is the tax and below-the-line cushion, not operating improvement. Returns moved the same way. Return on equity slipped to 6.3% from 6.8. Return on assets to 1.4% from 1.6. A large asset base earning a thinner spread. Cash is where the deterioration is sharpest. Operating cash flow came in at $9.3 billion, down 28.3% from just under $13 billion, far steeper than the 16% decline in net income, and that gap is the signal. Capital expenditure eased to $3.45 billion from $3.95 billion, so free cash flow was $5.85 billion against $9.02 billion a year earlier, about $3.2 billion less. The reassuring part, depreciation and amortization of $6.11 billion exceeds net income, structurally normal for a capital-heavy automaker, and cash conversion is still roughly 2.4 times net income. The profit is genuinely cash-backed, but conversion fell from about 2.8 times, and direction is what you track. Here is the mechanism. Since the start of the fiscal year, accounts receivable rose to $16.77 billion from $13.05 billion, up $3.7 billion. Inventory rose to $15.95 billion from $14.47 billion, up nearly $1.5 billion. Cash and equivalents slipped to $20.13 billion from $20.95 billion. That is more than $5 billion of extra capital tied up in receivables and stock, while revenue grew 0.5%. Money booked as profit is sitting on the balance sheet as unsold vehicles and unpaid invoices rather than arriving as cash. Inventory building into a North America segment that shrank is worth flagging. It either unwinds next period or it starts to weigh on pricing. Capital returns moved opposite to cash generation. Buybacks totaled $2.8 billion for the half, up from $2.01 billion. Dividends paid were $831 million against $319 million a year earlier. Together, $3.63 billion returned to shareholders, comfortably covered by $5.85 billion of free cash flow, but a much thinner surplus than the prior year. The financing line swung to an outflow of $6.45 billion from an inflow of $700 million. What made that affordable was the investing line. An outflow of $3.48 billion this half against $11.16 billion a year ago. Distributions rose, cash generation fell, and a smaller investing outflow bridged the gap. Sustainable for a period, not a trend to extrapolate. The balance sheet is stable. Total assets stood at $282.74 billion against $281.28 billion at the fiscal year end, up 0.5%, so no acquisition-driven expansion. Total liabilities were $219.1 billion versus $218.12 billion. Equity rose to $62 billion from $61.12 billion, with retained earnings up $1.47 billion, well below the $3.93 billion of net income. The difference paid out in dividends and buybacks. Two ratios to watch. Debt to equity of 3.53 times, structurally high, but characteristic of a captive finance arm where the loan book is debt-funded, and a current ratio of 1.14, with current assets of $110 billion against current liabilities of $97 billion. Adequate, not generous. Outside the financials, the signal window is almost empty. Zero open market purchases and zero open market sales by insiders on record, and the detailed transaction list is blank. That is neither bullish nor bearish. It just means the strongest insider read, open market buying, is unavailable here. On events, there is exactly one filing, an 8K on July 21st covering the release of second quarter results and supplemental materials, standard quarterly practice, filed the same day as the quarterly report. No merger activity, no leadership changes, no capital actions. The entire information content of this window is the filing we have just read. So what should you measure next period? 4 things. First, whether the 1.3 percentage point operating margin decline stabilizes or extends. The gap between 0.5% revenue growth and rising costs either narrows or compounds. Second, whether working capital unwinds. Receivables and inventory both built materially since year-end. A reversal would push cash conversion back toward the prior year's $9 billion free cash flow A further build would confirm a structural problem. Third, whether the buyback pace of $2.8 billion holds now that free cash flow has fallen by more than $3 billion. And fourth, the durability of international's near 14% growth and whether North America, 92% of the business, returns to growth. The half in one line. General Motors converted a flat top line into materially lower profit and meaningfully lower cash, with per-share figures held up by a 7% reduction in the share count. The pressure is on cost and cash conversion, not demand, inside a business where North America is 92% of revenue. The balance sheet remains stable and the profit remains cash-backed, but with less cushion than a year ago. Earnings quality reads as medium. If this breakdown was useful, subscribe for the next one.